Okay, so welcome back to the desk. We're going to move on now to exogenous analysis. The first thing we're going to do is actually link exogenous and endogenous together and have a look at the subtle differences between endogenous and exogenous analysis, so we can build a foundation and understanding of how we move forward properly in order to do a full exogenous analysis of a country like Australia against America, and how we build out a view on the exchange rate itself. So we'll be looking at the dynamic relativity principle in order to do this. We're then going to go back actually to our tradable set that we established near the beginning of the video series in the foundation section. So we'll be revisiting our tradable set of X commodity floating and commodity floating exchange rates. We'll then be looking at our first exogenous driver, which is relative GDP growth. And we'll also be looking in further videos at the other three exogenous drivers: the balance of payments and trade analysis, the interest rate differentials, and stock market returns and relative wealth. So in this video 17, we're going to be looking and concentrating on the relative GDP growth between Australia and the United States, and learn from history what happens with the Australian dollar US dollar exchange rate when GDP itself, or GDP expectations, move lower in Australia relative to the United States and higher in Australia relative to the United States, and what happens with the exchange rate throughout history, so we can get an understanding and build out our scorecards in a logical way. So let's go over to the computer screen. Let's start with relative GDP growth, and I'll see you at the end of the video for a conclusion. Okay, so we're going to start moving into our exogenous driver analysis now. And we're going to introduce the dynamic or relativity principle. So far, we've looked at an endogenous analysis. So applying the static or absolution principle to our overall analysis. And what this did was it allowed us to isolate our thinking and not be biased on scoring a country in its absolute entirety. So we basically build a view on a country or economic zone without actually needing to compare it to another country or economic zone. And this basically means that we've built a foundation of what we believe a country in isolation's currency is actually worth. So, for example, if we discover that a country or economic zone is inflationary in nature, then we're probably looking to seek a short currency bias, as the paper becomes worth less over time, and vice versa. If we see deflationary conditions, then the paper itself, because prices of goods are going lower, then the paper itself is becoming worth more. It can buy more goods. So looking to have a long currency bias in those circumstances. And in our previous example with the United States, we scored endogenously as mildly inflationary with a score of 36. And that was on a total sliding scale from deflation to inflation, most deflationary to most inflationary, of minus 150 to plus 160. And we can also see what's driving a nation's currency value, with the US as the biggest inflationary contribution at the moment coming from the government and the Federal Reserve itself. So when we actually look inside the endogenous analysis, what is actually driving either inflation or deflation. And what we discovered was that the biggest inflationary contribution was coming from central authorities themselves. And business and consumer deflation was also apparent. Even though the scores of the surveys were actually scoring quite high and they were positive, what was happening was that the inflation indicators, so our coincident indicators, were cancelling out our positive survey scores. And that was due to lower oil prices. And now endogenous scorecards can be used in isolation for all countries. And what we have to be careful of is that they're obviously not 100% rigorous, and they obviously don't provide a full bulletproof rules-based system. What they do is provide an internal measure in order to scorecard through a systematic process so we can measure the country in absolute terms objectively and to learn what is driving inflation and deflation at any one time. And also, as we learned earlier, they're also flexible in that over time the inputs can be added to and the scoring scales themselves can actually be adapted. Now this gives us a great foundation to go back to when we move on to the next stage of comparing one country versus another on a relative measure. So this is actually the exogenous analysis. And the drivers we use when we're analysing two countries relative to another are all drivers that are affected directly by the exchange rate itself between the two countries. Now, in the real world, the knock-on effects will be that the drivers will somewhat affect the endogenous drivers. However, our static absolution principle allows us to basically take a litmus test of where we are now relative to the past. Our exogenous analysis allows us to look for the clues as to the relative current situation between two countries and what might happen in the future. And we're buying and selling the exchange rate based on these expectations. Now, as an exogenous example, what we're going to be doing is using Australia and the exchange rate of the Aussie dollar, so the Australian dollar against the US dollar. And what you have to do is repeat the endogenous process for Australia yourself. So go through the whole process that we went through with the US dollar and scorecard Australia itself, applying all the same drivers, and you'll be able to get the data no problem. And this is one of the reasons why we're using Australia as an example, because it's actually quite straightforward for you to go out there and practice applying the endogenous process yourself to Australia. It's all the data is available out there. You just need to go and get it. Here, what we've done is shown you the endogenous process for the US dollar, so you get an example of how the endogenous process is applied. Then we're showing you the exogenous process for the Aussie dollar, US dollar exchange rate. And self-starters basically do not need to be told whether to buy or sell the Aussie dollar. You should be looking at this and applying the principles of the self-starter mentality that we've talked about in the past. So go out there, build your endogenous analysis, and then apply it to the overall process that we've been through. So you'll have a US dollar endogenous analysis, an Aussie dollar endogenous analysis, and then you'll have the exogenous analysis of the two taken together, which is what we're going to do now. So what we're showing you here is the process that you would go through as a professional trader, hedge fund manager, to get to the final answer. Now, Australia is categorized in our tradable set as a commodity floating major. So if you remember our tradable set from the earlier parts of the video series when we were doing our volatility analysis, we got to our opportunity set as our tradable set, and we split up into X commodity floating majors, X commodity floating minors, commodity floating majors, and commodity floating minors. And the difference between these two was currencies and currency pairs that basically are all floating, and they have diversity in terms of their currency. So their currency is exposed, the value of their currency is exposed to a multitude of factors. And on the right hand side, we have all of our floating currencies, because we, again, want the opportunity to make money. So we stay away from fixed regimes, and we stay floating regimes, focusing on floating. And the value of these currencies is very much weighted towards the value of one or two factors, so one or two commodities. And Australia, the Australian dollar, is categorized in our tradable set as a commodity floating major. And we're only going to be using one example here. What this will show you is how you apply the systematic process to all of these currency pairs. So you can go through and do an endogenous analysis for all the economic areas and countries that are in our tradable set, and then when comparing them with each other, do an exogenous analysis. Now, one thing we've just got to cover here quickly is something that we've touched on earlier on in the video series and on a couple of occasions throughout the video series, which is an exchange rate. You can't basically buy another currency without selling another first. It's very important to know that and remember it when we're going into the exogenous analysis, because in the endogenous analysis, we're looking at a currency in its entirety. Now the dynamic relativity principle applies. You cannot buy another currency without selling one first. So the way you have to view this is you have to view it as one asset, whether you buy it or sell it. And you do that through comparing the two countries and the macroeconomics exogenously. So comparing them relative to each other. And the dynamic relativity principle is essentially comparing the macroeconomics and then deciding whether to buy or sell this as one single asset. So always bear that in mind, that this is one asset. And obviously this dynamic principle of not being able to buy another currency without selling one first, and not being able to sell a currency without buying one. Keep that in mind as we go through the process. Now, going right back to the beginning of our endogenous analysis, we looked at our overall driver list, and we split up into endogenous, and exogenous. So what we're going to be looking at in this section of the video series is the exogenous driver analysis and scorecards 7, 8, 9, and 10. So we're going to start with relative GDP growth. So measuring the GDP growth of the United States versus Australia. And what we're going to be looking for is the differential between the two. Then we're going to look at the balance of payments and trade analysis between the United States and Australia, and also in its entirety. So Australia with the rest of the world and the United States with the rest of the world. We're then going to look at, in scorecard 9, interest rate differentials and carry. If you remember, In foundation, we looked at carry and rollover. Well, this is where this all comes back into play when we start combining this with the interest rates of the United States and Australia. So we start looking at the Fed funds rate versus the RBA rate in Australia. Then we're going to go on to scorecard 10, and we're going to look at the stock market returns or relative wealth between United States citizens and Australian citizens. So first of all, let's crack on with scorecard 7, the first of our exogenous drivers that we're analyzing, applying this dynamic relative principle, and let's look at relative GDP growth between Australia and the United States. So when we're looking at relative GDP rates, it's our first driver to compare two countries because we're looking essentially at the differential of growth between the two economies. So we look at the two countries or economic zones in relative GDP growth terms. How fast is Australia growing compared to the United States? How fast is the United States growing compared to Australia? When you think of this in terms of the absolution principle and the dynamic principle, if we looked at the United States alone, we could get a gauge on the value of a currency from its indicators pointing towards economic growth. So we get a value on the currency in its entirety in absolute terms. But when we compare it to another country, what we want to do when comparing two countries against each other is measure the relativity or the relative growth of the two economies and the speed at which they're growing relative to each other. So we create a relative measure for the historical comparison by looking at the difference or gap between Australian real GDP growth and US real GDP growth. And when the gap narrows, this means historically that Australian real GDP growth is falling relative to the US. When the gap widens, this means historically that Australian real GDP growth is rising relative to the United States. So if it's falling, then this is relatively deflationary for the Australian economy and relatively inflationary for the US economy. So our bias is to sell the Aussie dollar and buy the US dollar because policymakers will react to inflate in Australia and deflate in the United States on a relative basis. When the gap is rising, this is inflationary for the Australian economy and deflationary for the United States on a relative basis. So our bias is to buy the Australian dollar and sell the US dollar. Policymakers are going to react to deflate in Australia and inflate in the US on a relative basis. So we're going to look at some new spreadsheets now. We're going to look and start building out our exogenous driver analysis in our new sheet, exogenous driver analysis. And we're going to here, when we're looking at real GDP growth, we've actually provided you with a table with all the GDP values and percentage growth numbers for every country in the world. In this spreadsheet here, historical real GDP values and growth. Okay, so let's get stuck into this and go over to the spreadsheets. And the first one we're going to go to our exogenous analysis for Australian dollar, US dollar. So exogenous analysis, Aussie dollar, US dollar. And the file that we're in here is the relative GDP file. Now, if we go through our sources first, so we go to the sources tab, very similar setup to our endogenous format. First, we have relative GDP growth, we have relative balance of payments, interest rate differentials and carry, and stock market returns and wealth. When we start off in relative GDP growth, what we really want to get is obviously the GDP data. Now, for the United States, you can use the sources from the endogenous analysis spreadsheet. In the United States, we're going to be getting those numbers from the St. Louis Fed. Over here, what we're first going to do is show you how we got the data for every country in the world. So if we go over to our other sheet here, historical real GDP values, this data is coming from the World Bank. And what you have here is global GDP. Everything's going back to 1969, and everything's split up so into region. So we have Latin America here, South America, Europe, we have Asia and Oceania, Middle East, Africa. We have every country in the world. And all you have to do to get this data is if you go to this World Bank link here, this will take you directly online, and we're given a dataset variable choice. So what you'll do is when you first click into it, you'll be given country, series and time, and nothing will be selected for each section. What you have to do is select all, or if you're focusing on one particular country, just select that country, go into the data series, and if you scroll down, we're looking for G for GDP, and you'll see here that we've actually got GDP growth already checked. When you first go into this, this won't be checked. So click on GDP growth, and then for time, when you first click in, all of these will be unchecked. You just click on select all, and then at the top here, you can look at all of this data any way you want to, but we're just going to download it. And then this table will pop up. You'll get the choice of format that you want it in. So it's always best just to go for a .xls file, keep it simple. And everything else that's by default is fine. And we just click on download. And that pops down into your browser, and you just open this up, and you're given all of the GDP growth numbers for every country in the world by alphabetical order. So there's our row that we're interested in. We're interested in Australia. But what we've done is we've taken this data and we've organized everything for you already. That's just for you moving forward if you want to get hold of GDP data very, very quickly. Now, what we've downloaded is the values and the growth. So if we scroll down here to Australia on row 149, what we have here is the actual values of GDP on an annual basis, and then we have here the growth rates for each year. And this, if we scroll back to the top, this is going back to 1970. So we have the growth rates going back to 1970 and the values going back to 69. And what you have to do in your Excel formatting is basically turn this data around. So instead of it showing horizontally on the page, you want it to be showing vertically in the way that we formatted over here. Now, if we go into relative GDP growth, we can start to look at the rows and columns of our data to get a sense and understanding of how we work things out. So we start off on the left-hand side here in column A, and it's pretty obvious what's there. We've got the date set annually from 1974 onwards. In column B, we have the value of US GDP. In column C, we have the value of Australian GDP. In column D, we have the percentage change in US GDP year on year, so real GDP growth. We also have in column E, Australian percentage change in GDP, so real GDP growth in Australia. In column F, we have the differential between the real GDP growth rates. We've then also taken in column G the annual closing prices, so from the last trading day of each year, of the Aussie dollar, US dollar, and these numbers come in annually, so you can get these actually from the website that we looked at almost right at the beginning of the video series in Foundation. You can get that from investing.com/currencies. So if you recall Chris Quill showing you in Foundation where to get this data from, you can go into that resource and download all the data on an annual basis. So the time frame that you're choosing is yearly or annually. And then in column H, we've got the Aussie dollar, US dollar exchange rate percentage change for each year.
And then what we've done on the chart is charted on the left-hand side the GDP differential, so the red line, so column F, and on the right-hand side we've charted the annual percentage change in the Aussie dollar in the Aussie dollar US dollar exchange rate. So the green line in data coming from column H. And you can see there's a pretty strong relationship between the two historically. So when we have GDP differential between Australia and the United States widening, we get a rally historically in the Aussie dollar US dollar exchange rate annually. And when GDP differentials are narrowing or going lower, we get a sell-off in the Aussie dollar US dollar exchange rate annually.
And this is what we alluded to earlier when we were over at the presentation, that when GDP in Australia minus the United States, so the gap between Australian GDP and US GDP growth is falling, this is basically deflationary on a relative basis for the Australian economy and inflationary for the US economy. So we end up with a bias of looking to sell Aussie dollar to buy US dollar, because we know that policymakers will react to inflate in Australia and deflate in the United States on a relative basis. And the opposite holds true. If GDP in Australia minus the US is rising, so that gap is getting bigger, which means Australia is starting to grow faster than the United States relative to yesterday or the previous period. When this is rising, this is inflationary for the Australian economy and deflationary for the US economy on a relative basis. And our bias is to look to buy Aussie dollar to sell US dollar. Now remember our principle here, our dynamic principle, that we can't buy a currency without selling another one first, and vice versa. So this is why we use the phrase sell Aussie dollar to buy US dollar, buy Aussie dollar to sell US dollar, because we can't do what's on the left hand side without doing what's on the right hand side. So we have also our scorecard down here, and we'll come to that in a second when we go back to the presentation. But what we've also got here is our projected differential. So we're looking now forward at GDP growth in the United States for 2015 and Australian projected real GDP growth for 2015, and looking at the projected differential and comparing it to last year. And there's a small caveat here in that this number here for the United States, the projected number of 3.6%, this number was actually taken at the beginning of March from the IMF website, and recently it has come down. So we're looking at this historically now as if we were at the beginning of March 2015. So this is when we put all of these numbers together for you. Now, to get these projected numbers, all you have to do is go to the IMF links that we've provided. They're also in the sources tab. And you can see here the projected percentage change as set by the IMF for 2015, real GDP growth in the United States is 3.1%. So you can get that for every single country as well. And if you go to Australia, this opens up automatically and shows you 2.8. So a month and a half ago, US projected was 3.6% and Australia was 2.9%. So the differential was minus 0.7%, because we're doing Australia minus United States. Now, obviously that's narrowed since, so it's been rising. So just bear that in mind as we go back to the presentation, and we'll analyze this from the beginning of March 2015. And we'll go back to the presentation now and see how we build out our scorecard properly when we're looking at this. So just a quick rule of thumb to summarize on the expectations and moves of our bias. The rule of thumb here is on either side of the equation, whichever country experiences relative deflation, what's likely to happen is that they're more than likely the central authorities to act with an easing bias, so try to inflate, and vice versa. The country that's experiencing inflation relative or inflationary conditions relative is likely to experience deflationary tactics from the central authorities on a relative basis. So how do we actually go about scorecarding this whole situation? Well, our scorecard in this instance is inflationary all the way up the scale for percentage point differences, and deflationary all the way down the scale for percentage point differences. because what we're looking at here is Australian GDP growth minus US GDP growth. So this scorecard here, when we're looking at Aussie dollar, US dollar, we're deciding whether to buy or sell the currency pair Aussie dollar, US dollar, and Aussie dollar is the base currency. So we're scorecarding here for Australia relative to the United States. And by doing so, we get a bias on Aussie dollar, US dollar. Now, the reason why we have inflation all the way up and deflation all the way down is really because if we go through a few examples, when Australian GDP is falling relative to US, so i.e. deflationary on our scale for Australia, policymakers are likely to act in order to ease the deflationary pressures in Australia versus the United States and the rest of the world. So when we're in this area here, so Australian GDP falling relative to the rest of the world and falling relative to the US in particular. So Australian GDP minus United States GDP becomes negative. It's falling. And likewise, if Australian GDP is rising relative to the United States, so inflationary on our scale for Australia, policymakers will likely act in order to curb inflation or stop it from getting out of control. And our scale simply measures the gap versus the previous gap for both the United States and Australia. So in our example, the gap now has narrowed by minus 0.7% in 2015. That's what we're expecting to happen in the future. And that's coming from a previous positive situation in 2014 and also going back to 2010. So if you check through the numbers in the spreadsheet, you'll see positive numbers in 2014 going back to 2010. So this is deflationary for Australia relative to the United States and the rest of the world. And what happened? Well, policymakers did actually act. And if we had sold Aussie dollar, US dollar purely based on this difference in February 2014, so after full 2013 GDP numbers, so the number was becoming less positive, we would have sold the Aussie dollar at around 0.9. Now, what's quite interesting is that when we're looking at GDP numbers, we know by now that they're lagging. GDP numbers are backwards looking, so we have to be a bit careful. In reality, we would have been doing what we're doing exactly right now, which is forecasting GDP now till the end of the year. So in reality, at the time, we would have been in the same situation as we are now and forecasting that this was going to narrow. So the positive numbers were going to get smaller. So we would have actually been selling much earlier, and that's the way we've got to think. Because GDP numbers are quarterly, and we would have also had our endogenous analysis at the time, which would have included all of our leading and coincident indicators. So our leading indicators like surveys. So when you build out your endogenous analysis, you're going to start looking at things like the Australian PMI, which is the Purchasing Managers Index for Australia. And you'll be looking forward and using forward-looking GDP forecasts in your exogenous analysis. And you'll be seeing in real time what is happening to the endogenous drivers and forecasting what will be occurring in GDP and using the exchange rate as an instrument to express your view. So here the scorecard is pretty straightforward. Inflationary all the way up the positive side of the scale, because the gap between Australian projected GDP and US projected GDP is widening in the favour of Australia, and the opposite is occurring, deflationary all the way down the scale here, because Australian GDP relative to US GDP, the gap is narrowing in favour of the United States. So deflationary for Australia. So we just have to look at this in a logical way. We started off with our endogenous analysis. Now we're looking at our exogenous analysis. But knowing how the Forex markets work, we know that we can't sell another currency without buying another. So the Aussie dollar, US dollar exchange rate, when we express our view using this instrument on relative GDP of two countries against each other, when we use this as an instrument, we're looking at it as one asset. And the scorecard on the scale we get here as a -2. So there's a narrowing of the gap between Australian GDP growth, so expected GDP growth in Australia, and expected US GDP growth of -0.7%. So this equates close enough to our -1% GDP growth, which is on this row here. And this would pretty much represent a low conviction short in the instrument, Aussie dollar, US dollar. As things progressively get worse, we can always add to this winning position. If it does get worse for Australia, we can always add to it. So we'll be covering more on this on the risk management section. So that basically covers relative GDP growth. This is something you can apply as a driver to all currency pairs. And remember, you also always have to have your endogenous analysis in the background. And then the idea generation process continues with the exogenous analysis by pairing up the currencies that you've covered in your endogenous analysis. So we're just going through the process here, showing you how this is actually done. And we've got to the point, first of all, where we're scoring relative GDP growth between Australia and America. We're scoring a deflationary relative situation for Australia, because the real GDP growth in Australia relative to the United States is narrowing, and we've got a minus number. That's deflationary for Australia, and that means we're looking to short or have a short bias in the instrument Aussie dollar, US dollar, because this represents, as an instrument, our relative view on the Australian and US economies. Okay, so welcome back to the trading desk. Obviously, when we started on the computer screen there, you were introduced to quite a few new concepts about the exogenous analysis and how it differs from the endogenous analysis that we did earlier. The main difference really is this dynamic relativity principle, and that being you can't sell an exchange rate or a currency without buying another currency, or you can't buy a currency without selling one first. It's automatic. So the dynamic relativity principle means that when we're looking at an exchange rate and figuring out whether we buy or sell it, what we have to actually do is look at two economies relative to each other. And our subject in this case is the Australian dollar. So the Australian dollar is our base currency. And obviously when we go out to look to build our scorecards on an exogenous basis, we look at the Australian economy relative to the United States economy, and we look to scorecard as Australia being the subject. And it means basically that everything now is about relativity. We're not looking at a currency or country in isolation and deciding based on the endogenous drivers within the country that the currency is either in an inflationary environment or deflationary environment, so all things being equal, losing its purchasing power or gaining purchasing power on absolute terms or on an absolute basis. What it is now is deciding whether a currency is losing or gaining purchasing power relative to another one. So the subject being Australia means we look at our scorecards differently, because a deflationary environment for Australia means we have a short currency bias for the exchange rate Aussie dollar, US dollar, because the deflation is not deflation in absolute terms, it's deflation on a relative scale to the United States. And we're using Aussie dollar, US dollar as a proxy. Now, on the other side of that is the US dollar on the other side of the equation. And if it's deflationary for Australia, the other side, being the US dollar, means it's automatically, potentially inflationary for the United States. And if it's inflationary for the Aussie dollar, it's automatically, on a relative basis, deflationary for the US dollar. But don't get this wrong, it doesn't mean go out and either short or go long the US dollar against every other currency in the world, or maybe the dollar index. It doesn't work like that. What you're actually doing now is zooming in and comparing two economies relative to each other and specifically looking at the exchange rate between those two economies. So it's very, very important to understand the dynamic relativity principle and how it applies here. It's all about relative analysis, and that's what we're going to be scorecarding through the next section, the whole exogenous section. Scorecarding on a basis of the subject relative to another currency, but the other currency being the opposite side of the inflation or deflationary scale for the subject. It doesn't mean that you're scorecarding that currency against all other currencies. The endogenous analysis allows us to look at a currency in absolute terms. The exogenous analysis allows us to look at a currency in relative terms for the specific exchange rate between those two countries. So try to understand how the dynamic relativity principle applies. As we continue building out the exogenous analysis, it should become a lot more clearer how things work, but it's pretty straightforward and logical. Okay, so let's go over now to the next section of our exogenous driver analysis and start looking at the balance of payments and trade analysis.